India's financial services sector is one of the most dynamic in the world. Financial services in India is not one sector. It is a collection of sectors, each with its own regulator, its own FDI rules, its own licensing requirements, and its own level of scrutiny. The regulatory interface in financial services is genuinely lower risk from a corruption standpoint. The key is to start right. Hello and welcome back to the Veyrah Law series. In our last episode, we discussed outsourcing and the GCC sector in India. Today, we turn to a sector that is arguably the most sophisticated and possibly the most tightly regulated in the entire Indian economy: financial services. Let us start with why this sector matters so much. India's financial services sector is one of the most dynamic in the world. The banking, financial services, and insurance sector contributes approximately 27% of India's GDP. Nearly 90% of Indians are part of the financial system. Over 490 million UPI-enabled payment users, and a mutual fund industry managing assets of over $700 billion. The government has been a strong driver of formalization. Jan Dhan accounts, Aadhaar-linked banking, UPI as a global payment model. India's financial inclusion story is genuinely remarkable. Hundreds of millions of people who had no banking access a decade ago are now active in the formal financial system. And the consumption-driven base is still expanding. Insurance penetration in India remains below 4% of GDP, compared to a global average of over 7%. Pension and retirement savings are deeply underpenetrated. On the other hand, wealth management is booming, with India's growing HNI population. Every one of these gaps is an opportunity, but this is also one of the most heavily regulated sectors in India, and that regulation is not uniform across subsectors. Let us understand the landscape a bit. Not all subsectors are treated equally. This is the most important thing to understand upfront. Financial services in India is not one sector. It is a collection of sectors, each with its own regulator, its own FDI rules, its own licensing requirements, and its own level of scrutiny. Getting this mapping right before you begin is critical. Let us go through the main subsectors. Banking, regulated by the Reserve Bank of India. FDI is permitted up to 74% in private sector banks. Setting up a new private bank requires an RBI banking license, one of the most rigorous and time-consuming processes in the Indian financial regulation. Possibly insurance license coming a close second. Foreign banks can also operate as branches in India, subject to RBI approval rather than incorporating a local subsidiary. Insurance, regulated by the IRDAI, Insurance Regulatory and Development Authority of India. Recently, FDI was allowed up to 100% under automatic route for insurance companies. This is a significant liberalization from the earlier 74% cap. India's insurance penetration gap makes this one of the most attractive long-term opportunities in the entire sector. Next, we have capital markets, regulated by SEBI, the Securities and Exchange Board of India. Foreign portfolio investors, FPIs, can register with SEBI and invest across Indian equity and debt markets. Next is asset management. Foreign entities can also set up an asset management business in India. 100% FDI is permitted under the automatic route for asset management companies. SEBI as a regulator has a strong record of professional, process-driven oversight. The compliance environment here is demanding, but it is predictable. Next, we have non-banking financial companies, NBFCs, regulated by the RBI. 100% FDI is permitted under the automatic route for most NBFC activities. NBFCs cover a broad range: lending, microfinance, housing finance, infrastructure finance. Depending on the nature of the NBFC, different registration categories and compliance frameworks apply. Next, we have Fintech. India's Fintech ecosystem is one of the largest and most innovative in the world. Payments, lending, insurance tech, wealth tech, all are active and growing. The regulatory framework for fintech spans multiple regulators: RBI for payments and lending, SEBI for investment platforms, IRDAI for insurance distribution. The RBI and SEBI's regulatory sandbox provides structured pathways for new entrants to test products and solutions before full licensing. So the subsector determines almost everything. Let us look at what FDI levels and regulatory process looks like in practice. The FDI rules in financial services are more nuanced than in most other sectors. Not just the caps, but the conditions attached. For example, in banking, even within the permitted FDI limits, the RBI has extensive powers to examine the fit and proper status of foreign shareholders. In insurance, IRDAI conducts detailed scrutiny of promoter background, financial strength, and the proposed business plan before a license is issued. The quality of the regulator matters. SEBI, RBI, and IRDAI are sophisticated professional institutions. Their approval processes are rigorous, but they're also fair and broadly predictable. This is a meaningful contrast to the state-level corruption exposure one would experience in real estate and manufacturing, sectors which we will cover in other videos. The regulatory interface in financial services is genuinely lower risk from a corruption standpoint. That said, proximity to the regulator matters. SEBI and RBI are based in Mumbai. IRDAI is based in Hyderabad. For regulated financial entities, having operations and management in these cities facilitates regulatory interaction and relationship management. So what is the right approach for foreign investors entering this sector? Financial services in India is one of our preferred sectors for sophisticated foreign investors. Low corruption exposure, manageable labor law complexity, minimal broader taxation challenges compared to other sectors. The regulatory burden is real, but it is clean. Here is our practical framework. First, avoid highly regulated subsectors as your entry point. If you are entering India in financial services for the first time, do not start with banking. The licensing process is long, the compliance burden is high, and the RBI scrutiny of new entrants is among the most rigorous of any regulator in India. A better entry point is a relatively lighter regulated activity. An NBFC, a fintech platform, or a financial advisory business. Establish your India presence, build your regulatory track record, then consider expanding into more regulated territory. Second, for highly regulated subsectors, use a strategic joint venture. If the business requires a banking or insurance license, a strategic JV with an established Indian partner is almost always the better path. An Indian partner with an existing relationship with the regulator, an existing customer base, and existing regulatory approvals dramatically reduces your time to market. It also signals to the regulator that the foreign entrant is committed to the market and has credible local backing. The regulatory scrutiny that applies to licensed entities is actually a protection for the investor as well. Frauds and governance lapses in licensed financial entities attract immediate regulatory attention. SEBI and RBI have repeatedly shown that they will act swiftly when something goes wrong. That level of external oversight reduces the risk of the partner behaving badly compared to unregulated sectors. Third, for fintech and startups, India is genuinely open. If you are a fintech business or a financial services startup from another market, India is one of the most receptive environments in the world for you. The RBI and SEBI sandboxes allow you to test your product with real users before committing to full licensing. The UPI payment infrastructure is already built. The consumer is digital first. The distribution cost of reaching customers is lower in India than in almost any comparable market. And the gaps in insurance, pensions, lending, and wealth management are enormous. The opportunity for well-structured fintech businesses is genuinely exceptional. Fourth, for financial investors, this is a strong hunting ground. India's financial services sector also offers compelling opportunities for financial investors, private equity, growth equity, and venture capital. Regulated financial entities in India, NBFCs, insurance companies, asset managers, Fintechs, are among the most transparent, investable assets in the Indian economy. The regulatory oversight means financial reporting is rigorous. Related party transaction risks are lower than in unregulated sectors, and exit opportunities through strategic sales are well established. Next, keep the general structure clean. The standard structure for a foreign investor in financial services is a 100% owned subsidiary or a joint venture invested through an offshore holding entity. As with all India investments, root investment through a properly constituted intermediary entity. In financial services specifically, the fit and proper requirements of sectoral regulators mean that your group structure, ownership, and governance will be examined in detail. Keep the structure simple, keep it transparent, avoid complexity that creates questions rather than answers. To sum up, India's financial services sector is a high potential opportunity for the right investor. An enormous and still growing consumption driven base, deep penetration gaps in insurance, pension, and wealth management, a world class digital payments infrastructure already in place. The regulatory environment is demanding, but it is also clean, lower corruption exposure than most other sectors. The key is to start right. Avoid highly regulated subsectors as your entry point. Use strategic joint ventures where a license is essential. Consider fintech and lighter touch models to build your India presence first. And for financial investors, regulated financial entities in India are among the most transparent and compelling assets in the Indian market. As Warren Buffett has observed, someone is sitting in the shade today because someone planted a tree a long time ago. India's financial services sector is still in the early stages of its growth tree. The investors who plant early will be sitting in considerable shade a decade from now. And with that, we hope this episode has given you a useful framework for thinking about the financial services sector in India. If you found this video useful, please do share it. Thank you for watching and see you in the next episode.